Is your mortgage coming up for renewal and you don't know what to do?
Today we want to sit down with you to touch on some of the things that you should consider before heading into your renewal to make sure that you pick the best strategy moving forwards. Hey guys, Aaron and Josh here at the Findlay Mortgage team. Today we wanted to talk to you guys about your renewals, both on the residential and on the commercial side. Obviously, over the last year and a bit, we've seen rates increase close to 500% now, I believe it is. So, obviously as these renewals come up, there's going to be a bit of a sticker shock to a lot of individuals. So we want to talk about, what kind of thoughts you should have moving towards your renewals, what options you're going to have, and where we see some things going over the next few years in terms of rates.
Yeah, so renewals are definitely a hot topic. If you have a variable mortgage that has increased with the Bank of Canada overnight lending rate, then you obviously have already absorbed that pain. Anybody who's purchased a portfolio with Scotiabank over the last half decade has already felt these incremental increases to their rates. Now, obviously, this hasn't been the most comfortable situation for most people, but the majority of people who actually hold variable rate mortgages are on something called static variable mortgages. And what this means is that your payment doesn't actually change. It stays stagnant, but the actual amortization gets increased, meaning the interest payment on the actual payment increases to where most people don't even have any principal being paid down anymore, which is causing a huge issue or pushed off issue that we are going to be dealing with in the next few years.
Yeah, I think one of the biggest concerns that we're seeing here is the amortizations and potential buy downs of these static variable rates, and what that means come times at renewal. There's been some discussion from OSFI about not allowing the banks to have these overextended amortizations, and right now we're seeing these static variable rates amortizations up to like 75 years right now. So, when it comes down to renewal, if that 75-year AM has to get bumped back down to a 30-year AM, the question is, what does that do to your interest payment, or what does that do to a lump sum requirement, paying down that mortgage to get it back in track with that 30-year AM? So that's the concern on the statics. There has been some talk about banks moving away from statics as well too, just as a little FYI. But the main question is, what does that mean for you guys, and what kind of options are there moving forward? So the first thing that you really have to do is sit down and figure out what is your plan over the next few years, and what do you want of your real estate portfolio? Are you still looking for the cash flow? Are you looking to continue to scale? Are you looking maybe to just hold on to your properties for a little bit just to take that equity out to then reconsolidate and to move into something bigger? These are all things that you really need to have in mind before you come to us to figure out what is the next steps. Step number 2 should be get an idea of where your renewal rates are going to be. Typically lenders issue these about, it could be anywhere from like 90 to 30 days out before your renewal. If you're further out than that 90 days, maybe you can either call us, take a look at where the rates are with your lender. You could call your lender, have a discussion with them, and see, hey, if I were to renew or lock in early or refinance with you guys right now, what are you offering us? But get an idea of what the rates are being offered from your lender. Come to us, and then we can sit down and compare that to other lenders on the market and figure out, is there any cost savings with other lenders, and what does that look like? When it comes down to variable rates and breaking your mortgages, variable rates obviously contain a 3-month interest penalty. If you're in a fixed rate right now and you're coming up to the end of your fixed term and you're concerned about where rates are going to be, just keep in mind that breaking your fixed rate, you're either going to be the greater of your 3 months interest or your interest rate differential. In today's market, with interest rates being this high, you're probably going to be looking at the 3 months interest and not the IRD penalty on those fixed, but still an important thing to keep in mind. When we're taking a look at other rates on the market and trying to give you an idea of your cost saving on moving from a high rate to a potentially lower rate, we also want to keep in mind the cost of getting into that mortgage. So, on the A side, there aren't really any fees associated with your refinance. You have your cost to break and you have your legal fees, but there aren't, lender and broker fees to consider. If you're on the B side and you have a B mortgage, or if you're, an A guy and you were right on the cusp of being a B product, you're probably pushed into that B lender right now. And if you're going to be refinancing, you got to keep in mind that you're going to have a 1% lender fee and a 1% broker fee. So, on a $500,000 mortgage, you're going to have at least $13,000 to $14,000 in fees on a refinance. If we take a look at, what a 2-year fixed rate is, and let's say it is cheaper than the rate that you have right now, or the rate that's offered on your renewal, and your savings over 2 years is $8,000, but it costs you, $14,000 to get in this mortgage, you're not saving anything. You're actually losing money. So that's one of the things that we really have to take a look at is, are we just considering the rate and we're just looking at the aesthetics of the rate, or are we factoring in the total cost of your transaction?
Yeah, so here's some tips you should know, guys. When your bank gives you renewal documents, it is not going to be the most competitive rate on the market, specifically by design. So what's going to happen is they're going to give you a 1-year, 2-year, 3-year, 5-year, and possibly even a 10-year and a fixed and variable options. They are going to be a little more expensive than what you can currently get on the market. And that's specifically because what's going to happen is if you have variable debt in your entire portfolio, we have higher debt servicing ratios. For a lot of people right now who have entire portfolios of variable debt who are going to be moving into fixed rate mortgages, these banks are going to look at, well, what is the current payment going to look like, and when does that term come up for renewal? Because these banks are going to look at your entire portfolio, and if your debt servicing ratios have increased, a situation to be able to qualify for a mortgage conventionally with certain debt servicing ratio requirements, you're going to be in a situation where you either need to move to an alternative lender, a B lender, as Ehren was saying, or you just renew. Now, some things to keep in mind on renewal is you don't need to qualify for the loan that you currently have on renewal. And what we're seeing is most people probably can't qualify for the mortgages they have at the moment. So you may be in a situation where you can't do anything at the moment, and you got to ask yourself, what do you do in this situation? Well, we revert back to data. If you take a look at the video we just posted, I talk about where is the Bank of Canada going and where do we expect rates to be in the next 12, 24, and 36 months. Well, we do expect rates to drop over time. Now, when that happens, we don't have a crystal ball, but we are expecting at least by 2025 we're going to be in a much different rate environment. So if you have a renewal coming up between now and the next few years, and you don't think your TDS ratio is going to allow you to qualify, talk to us first. We'll take a look, we'll run the numbers, but if you don't necessarily qualify for the mortgages you currently have, taking a shorter term fixed option is going to be a little bit more expensive than you would have for a long term fixed, but it's going to give you the flexibility to be able to grab a much cheaper rate at renewal, or when rates are much cheaper at the end of that term.
One reason you might want to consider refinance right now, especially if that's coming up on renewal and you have some equity in your property, is going to be, if we can offset that cost of your higher, monthly mortgage payment to pay down some of your revolving debt. So, as we know, investors, we carry a lot of revolving debt. There's a lot of renovations to be done, on your properties. So, if we can get you into a slightly higher monthly payment mortgage, but decrease your overall portfolio monthly payments, on a win-win type situation, that is one situation right now where you might want to consider a refinance, even though you're refinancing into slightly higher mortgage payment. So take an assessment of the whole portfolio. What's your monthly income like right now? What's your monthly rental income, and where your debt's at? It's important to remember that there's two different types of debt payments that you're going to be considering. There's your actual debt payments that you're paying, month over month, but then there's also going to be your debt payments that a lender's going to take a look at. So your revolving debts, your lines of credits, your credit cards, the majority of lenders out there are taking a 3% of your outstanding balance. So even though your actual bank payment might be a little bit less, when you're looking at investing, and if you're buying right now, keep in mind that we're not taking a look at what's on your credit bureau. We're taking a look at 3% of that outstanding balance. So, if all your revolving lines of credits and credit cards are maxed out, it's really going to impact your ability to move forwards and purchase if you're not paying down that debt beforehand.
In a time like this, when rates are up in the air and everybody's situation is unique, it's really important to talk to a professional that understands all different types of capital and different strategies. If you have multiple different pieces moving at a single time, you're going to want to talk to a professional that understands how to stabilize a portfolio, or how to manage cash flow, or how to scale a portfolio in a market like this. So shameless plug, but dealing with a broker allows you to be able to deal with a professional that can move in and out of different types of capital and strategies. And in a market like this, it's never been more important to work with a professional that can advise you at a high level.
Well, guys, that's kind of the gist of where we're at right now in the market with the residential renewals. Obviously, any further questions specific to your unique circumstances, definitely reach out to us. We'll sit down, we'll take a look at everything. We'll go over the options and the scenarios with you. Part 2 for the commercial renewals and options and strategies are coming up next. So make sure you stay tuned for that.